Hello, and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Have you ever seen a hugely popular company, one whose products everyone uses, and thought their stock must be a surefire winner? It's a common thought. Many of us equate a successful, well-known business with a guaranteed profitable stock. But is it always that simple? Let's rewind to the dot-com bubble around the year 2000. Many tech companies were hailed as the future. Their names were on everyone's lips. Companies like Cisco Systems, a leader in its field, were considered fantastic businesses. Yet many who bought their stock at peak prices faced steep losses when the bubble burst. This illustrates a harsh truth. A wonderful company doesn't automatically mean its stock is a great investment at any price. As Warren Buffett famously said, price is what you pay. Value is what you get. Today, we're diving deep into this crucial distinction, the difference between a great business and a great stock. Understanding this can transform your investment approach. So what defines a great business? Think of a company with a strong, sustainable, competitive advantage, often called an economic moat. This moat could be a powerful brand, unique patents, a strong network effect, high customer switching costs, or significant scale advantages. A great business also has capable and trustworthy leadership, a team that navigates challenges effectively and acts in the shareholders' best interest. Financially, they are robust. You'll see consistent revenue and profit growth, healthy profit margins, and positive cash flow. Their products or services genuinely meet market needs. What makes a great stock? This is where things get interesting. A great stock is one that's trading at a price significantly below its intrinsic or true value. It means there's a substantial margin of safety, a concept championed by Benjamin Graham. This buffer protects you if your valuation isn't perfectly accurate. A great stock has high potential for price appreciation as the market eventually recognizes its true worth. It could be a great company, a good one, or even an average one if the price is right. The core difference? A great business is about operational quality. A great stock is about the relationship between market price and intrinsic value. They're not always the same. Many investors stumble by confusing these two. They might pour money into big, famous companies without considering the stock's current valuation. There's a dangerous belief that a good company is worth buying at any price. This can lead to buying at the peak, fueled by the fear of missing out or FOMO. You might love a company's products, but that doesn't automatically make its stock a good investment. Remember, you're buying a piece of the business, not just its offerings. Consequence of this confusion? Often, it's buying high and selling low, or holding on to an overvalued stock for years, even if the company itself is doing well. Think about a well-regarded, industry-leading company. Its business might be excellent, but if its stock was bought at an extremely high price, the investor might face losses, or a very long wait to break even. Howard Marks wisely noted the biggest risk is not price volatility, but paying too high a price for an asset. This hits the nail on the head. So why does this common mix-up happen? Often, it's due to crowd psychology. We're social creatures, influenced by what others are doing and saying. Behavioral finance tells us about biases like anchoring, latching on to the first piece of information, or confirmation bias, seeking out news that confirms our existing beliefs. A lack of foundational knowledge in financial analysis and valuation also plays a big role. Not everyone knows how to read financial reports or understand key ratios like PE or PB. And there's the media and sometimes ill-intentioned experts promoting hot stocks without solid backing. It's easy to get caught up in the hype. And let's be honest, sometimes it's just laziness. People want quick wins, the 3 magic letters for instant wealth, without putting in the research. Benjamin Graham, the father of value investing, personified the market as Mr. Market, who is often irrational and can offer great companies at bargain prices during pessimistic times. All right, how do we navigate this? First, assess the quality of the business. Is this a company you'd want to own for the long haul, irrespective of its current stock price? Look at its business model. Is it understandable? What's its economic moat? Is the management team capable and acting with integrity for the shareholders? Then dive into the numbers. Analyze revenue and profit growth over several years. Check profit margins, return on equity, ROE, return on assets, ROA, and debt levels. Consider the industry's outlook too. Is it a growing sector? What's the company's position within it? Warren Buffett advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Once you've identified a good business, the next step is to determine if its stock is a great stock. This means figuring out if it's attractively priced. Learn basic valuation methods. The price-to-earnings, PE ratio, compares the stock price to its earnings per share. Compare it to industry averages and the company's historical PE. Price-to-book P/B ratio can be useful for financial companies or when assessing liquidation value. Discounted cash flow (DCF) analysis, though more complex, estimates intrinsic value based on future cash flows. Crucially, always seek a margin of safety. If you estimate a stock's true value as $100, you might only buy if the market price is, say, $70 or less. This protects you. As Benjamin Graham stated, the margin of safety is always dependent on the price paid. With a sufficiently high price, any stock becomes speculative. Always compare. Finally, cultivate the mindset of a smart investor. This involves patience. Great opportunities, meaning wonderful companies at great prices, don't appear every day. Discipline is key. Stick to your strategy and criteria. Don't let emotions like fear or greed dictate your decisions. Think long-term. Investing is a marathon, not a sprint. And never stop learning. Markets evolve, and knowledge is your best asset. As Buffett also said, the stock market is designed to transfer money from the active to the patient. So, to recap, a great business is about quality. A great stock is about price relative to value. You need both for successful investing. You don't need to be a genius, but you do need patience, discipline, and the ability to distinguish between a good company and a good price. Investing in your knowledge always yields the highest returns. Warren Buffett also warned, risk comes from not knowing what you are doing. Think of it like shopping. You wouldn't buy a fantastic designer item at an exorbitant price just because it's good. You'd look for a sale. Investing is similar. So, my challenge to you is this. Start by picking one or two companies you admire. Learn about their business model, their moat, their financials. Then, try to assess if their stock is currently at an attractive price for long-term investment. Don't be afraid to ask questions and seek knowledge. This is how you grow as an investor. Thanks for listening. If you found this content valuable, don't forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.